Hey guys, today I'm going to be doing COMM 217 Chapter 3 Operating Decisions in the Accounting System. So first let's look at the legend. So anything already highlighted in yellow is our chapter title. Anything under that in blue is our heading, and under that is our subheading in green. So let's look at the main points. So one, describe a typical business operating cycle. So let me highlight that. Typical business operating cycle. And explain the necessity for the periodicity assumption. Explain how transactions arising from operating activities affect the elements of the statement of earnings. Explain the accrual basis of accounting. So let me highlight that in blue. And apply the revenue and expense recognition principles to measure net earnings. So in the book, we're not going to be covering in 217, so I won't talk about it in this video. So number 5, prepare a classified statement of earnings. And 6, compute and interpret the total asset turnover ratio and the return on assets. So I'll just write that as return on assets. 7, identify operating transactions and explain the differences between net earnings and cash flow from operations. So organization of the chapters. So here we have how do business activities affect the statement of earnings. You have your operating cycle, the classified statement of earnings. Then we have our how are operating activities recognized and measured. So we have accrual accounting, revenue recognition principle, expense recognition principle. Then we have the expanded transaction analysis model, the transaction analysis rules. It's analyzing Gildan's transactions. Gildan is the t-shirt company that we'll be using as an example. How is the statement of earnings prepared and analyzed? So classified statement of earnings, total asset turnover ratio, and return on assets, and focus on cash flows. So let's start. So how do business activities affect the statement of earnings? So operating cycle. So for companies to stay in business, they must generate cash from their operating activities, not from borrowing money or selling non-current assets. So companies acquire inventory and services and then sell them to customers. This defines the operating cash to cash cycle. So it begins when a company receives goods to sell, then continues when the company pays for the goods, then the company sells the goods to the customer, and then it ends when the customer or the company receives cash from that customer. So some companies attempt to shorten the operating cycle by getting customers to pay sooner than to buy sooner or pay faster. So an example of this is if the customer wants to do something and it's on a yearly basis, well, instead of a yearly basis, we could do a monthly basis and we'll receive cash sooner and faster. So periodicity assumption. To measure net earnings, accountants follow the periodicity assumption. So periodicity assumption assumes that life of a company can be reported in shorter time periods, such as months, quarters, and years. There are two types of issues arise in reporting periodic net earnings. So recognition issues. When should the effects of operating activities be recognized? Measurement issues. What amount should be recognized? So two, classified statements of earning. So the statement of earning is a statement of earning aids the user in identifying the company's earning from operation for the year and to highlight the effects of items on the net earning. So gross profit. Gross profit is equal to net sales minus cost of sales. Earnings from operations is equal to gross profit minus operating expenses. Earnings before income taxes is equal to earning from operations plus or minus non-operating revenue, expenses, and gains/losses. Earning from continuing operations is equal to earnings before income minus income tax expense. Net earnings is equal to earnings from continuing operations plus or minus earnings/loss from discontinued operations. Consolidated. So does a parent company pairing earning with smaller divisions for one complete statement of earnings. So consolidated statement of earnings for this example here just means a parent company pairing with its smaller divisions. So you could just look at that. So this statement of earning includes three major sections. One, the results of continuing operations. Two, results of discontinued operations. And three, earnings per share. So you can see that here. Discontinued, where's discontinued? So continuing operations, this section presents the results of normal or continuing operations. Operating revenues is revenues defined as increase in assets or settlements of liabilities from ongoing operations in the business. Operating revenues are the amounts earned and recorded. When revenues are earned, cash or accounts receivable are usually increased. When a company receives cash in exchange for a product or service in the future, this is a liability. So let me highlight that in red. So when a company receives cash in exchange for a product or service in the future, this is a liability or a deferred revenue. When that product or service is eventually provided, then the revenue is recognized and the liability is settled. So just to emphasize, it becomes a liability for the company when they receive cash before they provide a service. It's because now they must provide a service in the future. So that's the liability that counts in this example. So operating expenses. So expenses are decreases in assets or increases in liabilities from ongoing operations only when an asset is used to generate revenue. They are the costs of operating the business that are incurred to generate revenues during the period. So expenses and expenditures are not the same thing. Expenditures are any outflow of cash for any purpose. The following are primary operating expenses for most companies. So you have one, your cost of sales. It's pretty much just the cost of products sold to customers. So let me highlight that in orange. So gross profit or gross margin is just net sales minus cost of sales. Two, selling and distribution expenses. So the salaries of all personnel who support the sales effort include sales personnel, marketing and promotion, distribution of products, rental of warehouse space, insurance. So three, administrative expense. It's a variety of expenses related to the salaries of administrative personnel. Includes legal counsels, accountants, and computer technicians, travel and telecommunication services. So let me just highlight that. Three, administrative expenses. Four, gains or losses on disposal of assets. So companies dispose, sell, or abandon property and equipment sometimes. Gains are increases in assets or decreases in liabilities that result when assets other than investments are sold for more than their cost. Losses are decreases in assets or increases in liabilities resulting from the sale of assets other than investments for less than their cost. Abandoning property and equipment results in losses. So earnings or losses from operations, also called operation income or loss. Operation income or loss is just the net sales minus the cost of sales and operating expenses. So non-operating items, so any revenue, expenses, gains, or losses that result from these other activities are categorized as non-operating items or other income or expenses. Interest income, it's using excess cash to purchase operations of manufacturing and selling family apparel. Therefore, any interest or dividends earned on the investment are not included as operating revenue. Financing costs. So any cost of using money, called interest, is an interest expense. Gains or losses on sale of investments. Sale of investments for less or more than their original cost results in a loss or a gain that is reported as non-operating items. Earnings losses before income taxes is equal to revenues minus all expenses except income tax expense. So income tax expense is the last expense listed on the statement of earnings. So let me highlight that. Last expense listed on the statement of earnings. Required to compute income taxes owed to federal, provincial, and foreign governments. Income tax expense is calculated as the percentage of earnings before income taxes. So discontinued operation. So any discontinued major component of a business is disclosed separately as a discontinued operations. Earnings or loss per share. So corporations are required to disclose their earnings or losses per share on the statement of earnings. This ratio is used in evaluating the operating performance and profitability of a company. So earnings per share, I'll put this in pink. Oh, I don't know how I did that arrow, but let's just pretend that it's not there. So earnings per share is equal to net earnings divided by the average number of shares outstanding. So how are operating activities recognized and measured? Your financial performance is measured as the difference between your account balance at the end of the period and the balance at the beginning of the period. Cash basis accounting. So its revenues are recorded when cash is received and expenses are recorded when cash is paid, regardless of when the revenues are earned or the expenses are incurred. So let me highlight that in purple. When cash is received. So accrual accounting. So in accrual basis accounting, revenues and expenses are recognized when the transaction that causes them occurs, not necessarily when cash is received or paid. So let me highlight that. So revenues and expenses are recognized when the transaction that causes them occurs, not when cash is received. Recognize revenues when earned, so good delivered or services performed. Recognize expenses when incurred, so resources used or debts incurred to generate revenues in the same period. So accountants are guided by the revenue recognition principle and the expense recognition principle. So revenue recognition principle, it specifies that both the timing and the amount of revenue to be recognized during an accounting period. It requires that a company recognize revenue when a good and services are transferred to customers in an amount it expects to be entitled to receive. The 5 steps to follow for recognizing revenue. So at 1, identify the contract between the company and customer. So a contract is created when Gildan Stores agrees to sell a t-shirt at a price of $10 to a customer who pays the amount electronically. 2, identify the seller's performance obligations, so promised goods and services. A performance obligation for Gildan, and that is to deliver the t-shirt to the customer. 3, determine the transaction price, so amount the seller expects to be entitled to receive from customers. So Gildan, the transaction price is the amount that is charged to the customer minus any discounts, such as the $10 agreed upon t-shirt. Allocate the transaction price to the performance obligation. So the transaction price relates to the t-shirt that is sold to the customer in the Gildan's example. 5, recognize revenue when each performance obligation is satisfied. So Gildan recognizes the revenue upon delivering of the t-shirt when it transfers to the customer any future benefit from ownership and control of the t-shirt and receives the agreed upon payment. So now the t-shirt no longer belongs to Gildan, it belongs to the customer, and the money that the customer has no longer belongs to them, it belongs to Gildan. So that pretty much explains the revenue recognition principle. So cash received scenarios. So 1, cash is received before. So let me highlight that. Before the goods or services are delivered. So in this case, we want to debit cash or assets and credit deferred liabilities or deferred revenue, sorry. If cash is received in the same period as the goods or services are delivered, debit cash or assets and credit sales revenue in the revenue account. So 3, cash is received after the goods or services are delivered. You want to debit accounts receivable because it's going to be received later on an account, and credit sales revenue in the revenue account. So when cash is finally paid, so in the future now, we want to debit cash assets as our cash is increased since we just received the cash, and we want to credit accounts receivable for the same amount of that we debited the cash. So expense recognition principle. So the expense recognition principle requires that expenses be recorded in the same period when incurred and in earning revenue. The cost of generating revenue include expenses incurred such as salaries to employees, utilities for the electricity, inventory items sold, facilities rented, use of buildings and equipment for production. Cash paid scenarios. So one, cash is paid before the expense is incurred to generate revenue. So debit office supplies such as in the assets account, and credit cash in the assets account as well. So we could see here an example of this is since we're debiting office supplies, since that's going up, and we're crediting or removing $2,000 from the cash account. So two, cash is paid in the same period. So on payment, in this example, on payment of $500 cash for using a repair service. So we want to debit our revenue, so repairs expense. Our revenue is going to be going up. And then we're crediting cash since we're paying something. Or sorry, not our revenue, it's our expenses. So our expenses are going up with the repairs expense, and our cash is going down with a credit to our assets account. So three, cash is paid after the cost is incurred to generate revenue. So in this example, on the use of 4,000 employees services during the period. So salaries expense, so our expenses are going up by 4,000 since we're paying salaries, and our salaries payable, our liabilities goes down since we are paying off the salaries. On payment of cash after using employee services, so salaries payable, so 4,000, so we're taking off a liability, and crediting cash since we're using cash to pay off those salaries. So 5, how is the statement of earnings prepared and analyzed? Accounts listed on the statement of financial position, so assets, liabilities, and shareholders' equity. Accounts listed on the statement of earnings. I'm not too sure why this is, there's a line on earnings. There shouldn't be any, so don't worry about that. Let me just see if I can remove it. I guess maybe not. That's interesting. So yeah, just pretend like it's the statement of earnings. So revenues and gains and expenses / losses are part of the accounts listed on the statement of earnings. Note that unadjusted balances are not presented to external users. So if we ever see a balance that says unadjusted balance, that just means that the accounts and the journal entries weren't properly adjusted. And those that are not adjusted are not presented to external users. Those are just for internal users. So the accounting cycles. So we have record journal entries, post entries to ledger accounts, prepare unadjusted trial balance, adjusting journal entries. So we want to adjust it here. Prepare adjusted trial balance, record reversing entries, prepare post closing trial balance, record closing entries, prepare financial statements. So classified statement of earnings. So this statement of earnings does not at this point reflect all revenues earned or expenses incurred. Unadjusted just means that posted before any adjusting entries are made to the balance, like I explained before. So after the adjustments are made, the amount of income tax expense and net earnings will be reported in the statement of earnings. So you go to the statement of earnings. So 6, total asset turnover ratio and return on assets. So in chapter 2, we discussed the current ratio used to evaluate the company's ability to pay short-term obligations. We now introduce 2 ratios to assess managers' use of assets and total to improve net earnings. So let's look at them. So total asset turnover ratio. So how efficient is management at generating sales from assets? So how do we do that? So we can find total asset turnover ratio, which is equal to sales revenue divided by the average total assets. So return on assets are ROA, as in the abbreviation of it. So it's how well has management used the total investment in assets financed by both debt holders and shareholders during the period. So return on investment, ROA, is equal to net earnings divided by the average total assets. So 7, operating transactions, net earnings, and cash flow. So operating activities. So the statement of cash flow. So we have O, which represents operating activities. This includes primarily with customers and suppliers, payments to employees, and payments of interests. I, or investing activities, include buying and selling non-current assets and investments. F, or financing activities, include borrowing and repaying debt, short-term bank loans, issuing and repurchasing shares, and paying dividends. So examples to typical activities of the corporation. So the type of activity, either OIF, which means operating, investing, or financing, and the effect on the cash flows. So here, let's take an example. So 1, payment of dividends to shareholders. This would be a financing activity since we're paying dividends, and this would be a minus to the cash flow. So receipt number 2, receipt of cash from customers. So that would be operating activity since we're dealing with customers, and it would be a plus since we're receiving cash. 3, purchase of property and equipment for cash. It's equal to I since I include investing activities such as buying or selling assets and investments, and property and equipment is part of an asset and it's part of a non-current asset. So this would be a minus as well since we're purchasing a non-current asset. 4, payment of income taxes. So this would be an operating expense and it would be minus on the cash flow. Number 5, payment of cash to suppliers. So this would be operating activities as well, and also minus on the cash flow since we're dealing with suppliers. 6, repayment of long-term debt. So this would be a financing activity, which is also a negative on the cash flow since we're borrowing or repaying debt. 7, receipt of interest on investment. This is an investing activity, and this would be a plus on the cash flow. 8, cash proceeds of long-term debt. This is financing activities, and it's a minus since we're paying off we're paying debt. So 9, issuance of shares. So it would be financing, and it would be a plus because we're including shares and we're purchasing or we're issuing shares. 10, payment of interest on borrowings. So this would be a financing activity and minus on the cash flow. 11, payment of cash to employees. So this would be an operating activity and minus on the cash flow. And 12, sale of property for cash is an investment activity and plus on the cash flow. Thank you.